From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Ferro. Tech, the ego has taken a bruising. The field of dreams has just been punctured. Tech is bruised. Countdown to the Open begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, big tech delivers a big letdown, pulling futures lower for a second day. This as investors turn their attention to the Fed. We begin with the big issue. Big tech, big miss.
These are good numbers, but the expectations were huge. And there's a real issue of traveling and arriving. You know, the markets have been rallying strongly, not just in mega cap tech, but broadly speaking. These are not bad numbers. These companies are generating fantastic revenue growth and are in a very strong position. But I think, you know, the upside from a market perspective in the short term was likely to be limited given the expectations that have been priced in.
Well, let's bring in our roundtable. It is BlackRock's Kate Moore and Jim Bianco of Bianco Research. So, as Peter just said, as travel and arrived, the expectations were so high. When you look at this mini drawdown, Kate, it's almost sort of like, I think it's sort of quite a relief, really, to see a little bit of the air come out of the tires.
Yeah, I have to say, it is a healthy bit of a drawdown. You know, there was a lot of angst in the last couple of weeks about how strong the performance of tech had been year to date. We know it's the best performing sector, up over 6%, and taking a little bit of air out makes sense. But let's be very clear. The earnings that came out last night were excellent earnings by any measure. They just maybe didn't meet the loftiest of lofty expectations. And we have a lot more tech earnings to get through this week. I think we're going to find that the sector is in extremely strong health and that there's a lot of opportunity to stay invested in tech throughout the course of 2024.
So, Jim, good morning. Good to see you. For you, these record highs in equity markets that we've seen cascade in pretty much every day last week, it's had a slightly different ramification for you on the corporate bond issuance. That's at record highs. What are the ramifications of high equity markets for you in the credit space?
Oh, I think that it is a loosening of financial conditions and the ability for companies to want to not only issue, but have it issued. And we've seen that with record corporate bonds. And I think it filters through to the economy as well and really makes the case that the Fed shouldn't be in any hurry to cut rates. I know they like to talk about being restrictive, but with record bond issuance, with an all-time high in the stock market, with economic data beating left and right, I'm having a hard time finding what exactly a 5 to 5.25 or 5.25 to 5.5 funds rate is restricting. So when you look at what's happening with equities and with corporate bonds, you have to kind of turn around and conclude that the economy's okay and there shouldn't be any hurry for them to cut rates.
Well, you're bang on the money. It's not restricting anything because we have COVID hangover. We've got a structurally different work week and we've got a fundamentally different economy. Let's dig a little bit deeper into these tech earnings because they have skewed the risk this morning. We're off to a shaky start. Alphabet, Microsoft, AMD, all dropping short of their lofty expectations. Mandeep Singh is Bloomberg Intelligence. He joins me now. The nuance you say is to understand perhaps the difference between Microsoft and Google in terms of AI. Just differentiate for me.
Yeah, I mean, look, in the case of Microsoft, we know AI contributed about $4 billion in revenue, and it was 6% of their Azure growth. So clearly, you know, and it doubled from last quarter. So a lot of momentum for Microsoft, and not too, you know, just with large language models or copilots. It's that entire stack. In fact, they gave a metric. The number of enterprise customers for Gen AI were around 51,000, and 1/3 were new customers. That tells you something. If Microsoft is signing up new customers, I mean, given their enterprise footprint, the Gen AI thing is real and it's helping them expand their customer base. So Microsoft is becoming the most sticky product when you think about it from an enterprise perspective, both on the application side and the infrastructure side. In the case of Alphabet, I think the search is the real concern, how much it could get disrupted. But the cloud revenue did go up, and that's what Street wanted to see.
Do you think the advertising was that disappointing? I mean, on paper, it doesn't look huge, but we've written a monstrous amount about the disappointment there.
Yeah, look, they have the 90% plus share, and they keep growing, in double digits. The concern is, can they sustain that double-digit growth, or it's going to taper off to high single-digit? And I think based on the commentary yesterday from management, it sounded like they said the base is too high and search may not be growing double digits in the next 2-3 quarters, which is why I think you saw this kind of reaction.
Okay, it could be a long variable lag in the advertising and on the search side. Mandeep, thank you very much. Mandeep Singh there on the tech reporting. Let's take it back to BlackRock's Kate Moore. Kate, this is what you write. We entered 2024 with a pro-risk portfolio on the back of a resilient U.S. economy, supportive disinflation trends, and a core belief that peak rates are behind us. As such, we've been tactically adding to our portfolio risk, capitalizing on cheap vol and using derivatives. I mean, this must be one of the days that you relish. A little bit of a spike in vol, but things cheapen up. So where do you deploy to broaden your reach on days like this?
Yeah, so I would say there hasn't been a lot of trading in the last 2 days as everyone's been waiting for the FOMC decision and, of course, the 40% of S&P 500 earnings that are getting released this week. So there's so much to digest, and positioning super aggressively ahead of that doesn't always make a lot of sense. That said, we have been, to my note, pro-risk and have had higher beta than normal because we've seen great opportunities across the equity market. I want to go back to a point that Jim made earlier, which is that higher real rates have not really been cramping the economy. And we've seen this across a wide variety of sectors. Company management teams have been telling us activity looks good, our prospects look strong, and even with these higher rates, we still see prospect for significant earnings growth in 2024 after earnings contraction in 2023. So it's kind of hard to step away from the market. That said, we have been using derivatives very aggressively. We see volatility in certain areas as being priced very low, and it's been a great opportunity for us to buy vol at those levels.
I'm curious, Jim, for you, when you see a lot of people who come on one after the other talking about low vol, low MOV, low VIX, a prime opportunity to pick up protection. In that lowish volatility regime, how does that manifest itself for you?
Well, it does because of the stock market going up. There is an investor skew involved that it goes down. But I've always contrasted it with what you see in the bond market. And in the bond market, the volatility numbers are above average. And in the last month or so, they've been way above average. And you've seen a lot of volatility there and in the commodity markets, too. I mean, we've almost grown accustomed to, take one example, crude oil moving 2 or 3% a day. That I'm old enough to remember when that was a big deal. Now that's Thursday. Or that's Wednesday in the crude oil market. So yes, the vol numbers are very low in equities, but when you start drifting away from them and you start looking at fixed and you start looking at commodities, those vol numbers are much, much higher. And I think that represents an uncertainty about Fed policy, about global monetary policy, about the state of inflation. The stock market has decided that it's gone. Inflation is gone. The Fed needs to cut rates. Everything's okay. But I think when you look at commodities and fixed income, they're not so sure.
Jim, don't worry, you're not the only one that can remember moves in crude oil. In 1991, I think I got my first Bloomberg, and I understand what a crack spread was. Traded it very badly. The Band-Aid's about to come off in the Bank of Japan. What's that going to do to dislocate flows around the world in the bond market? Jim, briefly.
I think that it may be a big dislocation because the Bank of Japan or Japanese are the largest treasury buyers in the world, even larger than China. If they allow their rates to go up and compete with the U.S., you're going to see money being diverted back to Japan.
Kate, you're a buyer of Japan. In what kind of scale? I've had various people that talk about it since I came to live here, but it's not a big theme. You are behind Japan in the medium term?
Yeah, look, and we've had a modest overweight to Japan, a modest overweight that we're looking to add to, and particularly to domestic-oriented stories. We're seeing greater momentum in the Japanese equity market and in Japanese consumption. And we think it makes a good relative bet and a balance to what is also our highest conviction country weight, which is the U.S. Mm-hmm. The one thing I will kind of note here is that a lot is going to depend on the inflation trajectory. We have great hopes for a little bit of inflation in Japan and this rotation in terms of BOJ policy. But at the very heart of it, we see strong fundamentals for Japanese companies. And I think earnings, whether that's in Japan, in the US, or in pockets of Europe, are going to be what leads the equity market higher this year.
OK, hold those thoughts. Kate Moore and Jim Bianco, my guests this morning on the panel. Let's stick with stocks. Guess what? Ahead of the opening bell, bit of a thought. Could be tech, Abigail Doolittle.
It could be tech, and it is tech, Manus. Let's start off with some of those shares that are really falling and pressuring some of the major indexes, starting off with the shares of Alphabet down more than 5%. This, of course, after the Google ad revenue missed on tepid search growth. Investors not liking that, down 5.6%, given the fact also that the stock had been up more than 8% year to date alone. Just not good enough. AMD down 4.1%. Their fourth quarter was lackluster, and the revenue forecast disappointed. Microsoft kind of flipping between gains and losses. They beat, but against the backdrop of a high bar expectation quarter, it seems investors maybe wanted a little bit more. Some analysts are saying that the cloud disappointed, and others are saying that it was just a little lackluster overall. Paramount Global, on the other hand, look at that stock, soaring up 15%. This is media mogul Byron Allen has made another bid for Paramount, $14.3 billion this time. That equates to $28.58 per share. As you know, Manus, the stock not even 40 to 45% of the way there, suggesting investors think that this deal may not get done.
OK, Abby, thank you very much. Yeah, Microsoft adding 51,000 customers on the AI side, as Mandeep just pointed out. Coming up on the show, you got it. We're counting down to the Fed.
The Fed has been reluctant to wave the victory flag, but maybe they'll start to raise it and let it blow a little bit in the tailwinds of the economy.
Digging ahead to Chair Powell and the Fed. That conversation we're counting down on Bloomberg.
Watching the Fed, of course.
We know that the Fed isn't going to do anything. It's probably going to remain on a pause,
on hold a little bit longer here.
The Fed's in a really tricky spot.
It's a very, very tight rope.
Officials will more clearly outline how they're thinking about rate cuts over the next year.
They'll move to a more kind of balanced language.
We're going to hear Powell more in this careful camp.
It's, in Powell's best interest to be neutral here.
They may send a signal to help people begin to ground their expectation.
Probably going to maybe pull back a little bit in terms of the expectations that is already in the market about March.
The Fed's just going to be essentially validating at least some of what markets are pricing in.
They'll keep the door open.
I think he's going to say that there's been progress.
If you look at the amount of progress you've had on inflation, it's been really substantial.
The Fed can take some credit for that and some comfort in that.
Things are moving in the right direction.
The Fed has been reluctant to wave the victory flag, but maybe they'll start to raise it and let it blow a little bit in the tailwinds of the economy.
Nobody's taking a victory lap yet, certainly not at the Fed. The investors are looking ahead to the discussion today. The latest rate decision will come at 2 p.m. Eastern, followed by the chair, Mr. Powell's news conference. 30 minutes later, Bloomberg's Mike McKee joins us from Washington, D.C. with a preview. So, Mike, what will the shift in the nuance be, perhaps, in the FOMC statement? Let's start there, what we're punting out as the shift, first of all.
Yeah, Manus, that's a good way to look at it, because it's been since July that we've been talking about it's more important what the Fed says than what they do, since they haven't raised rates since it was warm in the summertime. No rate move again expected today, but it is a question about what they say in the statement. They've been talking about additional firming for all of those months. Now that part of the statement is likely to go away, and the Fed will find some way to massage it to suggest they have hit the peak. There are no new economic forecasts and no dot plot this time, so we probably aren't going to have anything to chew over about what the Fed thinks is going to happen. And so we probably won't get any guidance on rate cut timing, possibly some talk about the balance sheet. Jim Bianco was talking a little earlier about what is the Fed restraining? Well, maybe job growth. ADP comes in low, 107 this past month. That is well below what was anticipated. And if that's the case, then we could see the market be wrong about what it thinks is going to happen on Friday with a forecast for 185,000 jobs and a jump in the unemployment rate. Also, no real change in the year-over-year average hourly earnings. But there was good news from the ECI today, the Employment Cost Index. It went down, not down, but it grew at a slower pace, 0.9%. That is still ahead of inflation, so you're still getting a benefit there, but it on a year-over-year basis is annualized to about 3.5%, which is what the Fed has been looking for in employment compensation. So there is a slowing economy, and we'll see on Friday if we have a slowing labor market. The Fed at this point can stand pat and probably not say as much as people would like them to, Manus.
Probably, Mike. They'll be pushing them on timing and on QT. Mike, thank you very much. A very clean run through on the data. My guests this morning are Jim Bianco and Kate Moore. Jim, I want to take it to you first of all. I mean, there's a fine line. There's a wonderful phrase the Brits use, which is, loose lips sinks ships. How does he thread the needle today to deliver neutrality and, I presume, optionality for March? Should March still be live at the end of this press conference tonight, Jim?
Well, March is live now. If you look at the latest probabilities from the market, it's essentially 50-50. And what he says will have a long way as to which way it goes. I think he preserves his optionality by stressing, the old saw that the Fed likes in data dependence. If the data continues to warrant the idea that inflation is moderating and the economy can see some kind of room for them to lower rates, they will. I might add that 2 weeks ago, the probability that they were going to cut rates in March was 85%.
Yeah.
And now we're down to 50-50. And I think that represents that the data has been a little bit stronger than the Fed needs. So if that continues with that stronger data, then all of a sudden March might be pushed into May.
Kate, I ask this to many equity investors. The velocity of the equity rally, the ramp in the NASDAQ, the ramp in the technology side relative to value has to a certain extent been predicated on rate cuts. How much will it interfere with your overall thesis if it's 3, 5 or 6 rate cuts? I know there is a differential between 150 basis points and 75 basis points, but materially from an equity investment point of view, how much difference will that make?
Yeah, it will make very little material difference, in my view, to the equity market direction over the course of the year. I mean, we are at a point where we're talking about when, not if, the Fed adjusts policy rates over the course of 2024. And most importantly, the leaders across technology and across these other sectors are not dependent on lower rates for performance. What we want to see is kind of a glide path of the economy where we have growth, but perhaps a modest deceleration. The consumer looks good. Demand for things like AI, software, and tools continues to stay robust. I mean, that's the best story for their earnings in the S&P 500. What I will say is, this is a very different market from balance sheet, from leverage, from dependence on debt than it had been in previous rate hiking and rate cutting cycles. So we need to acknowledge that there is not an easy comparison and acknowledge that the health of these companies, particularly in the tech sector, the return on invested capital, the free cash generation, are at levels they've never been before. So I don't want to sound like a wild bull here, but I think we need to be constructive. There's a fundamental reason, not just a rate cut reason, why these equities are outperforming. I think we're going to get fits and starts, periods of trading consolidation, and perhaps we're entering one of those right now. But we'll continue to make new highs throughout this year, and it pays to be risk on.
Yeah, I think for most of us, it's probably just that hesitancy and a sharp intake of breath at the speed with which we got here. We got to the end of 2024 targets for a lot of houses almost done and dusted with very little breath left on the upside. Jim, can I take it back to you? One of the best lines I've heard, and I've heard many, is from Claudia Sahm. Of course, she is the author of the Sahm Rouge. She said the Fed should just get out of the way. They've got a dual mandate. One is inflation, that's being behaved. And the second is full employment. And we're at it. Get out of the way, Fed. But can you be that bullish? And therefore, what does that mean for loading up on this mini handbrake turn in yields?
Yeah, I think that the risk of that idea that the Fed needs to get out of the way is the presumption that we've got inflation licked. I know that everybody says we've got inflation licked. They also said it last year. They said it 2 years ago within transitory. And it just continues to be the story that there isn't an inflation problem. Count me in the camp that thinks that there still is. Yes, we had transitory inflation. It got us to 9%. But once that smoke dissipated, I still think we're in a 3 to 4% inflation world. I think the last mile has already been run, to use that metaphor, and that we're probably near the lows of inflation. And that's going to be a problem for the Fed. Now, if that is, then this presumption, get out of the way. Let's just cut rates. Let's just declare victory. Could look a lot like what we saw in the mid-'70s when the Fed did the same thing, and then you fostered a resurgence of inflation. So let's be sure that inflation is done and behind us. And I think that we're in a post-pandemic world and that the economy's changed enough that people are more in a spending mood, that if you give them more stimulus, you're going to see more inflation. And that's what my concern is.
By the way, I want to remind you, the world didn't stop at 5% rates in the 90s or 6%. The world did continue to run. And we bought houses and we did different things. So, Kate, let me bring it back to you. I want you to live in a world of where the last mile is tough and there's a stickiness at 3%. It's not that much of a challenge for you in 30 seconds.
Yeah, I don't think it's much of a challenge at all. And as I mentioned, companies have made significant changes to the way they approach debt, termed out their debt, and locked in very low rates. We know that for the S&P 500, the average effective debt rate is around 3.3, 3.4%. So I think we're in good shape. A 3% environment where we have moderate growth and consumer stays high and we have lots of reasons to be optimistic is a great environment. I'd rather be there than a 0% where we're concerned about recession.
Shape up and look large. Kate and Jim Bianco, my guests this morning. No fear in either of you. Coming up on the show, your morning calls with JP Morgan's Bob Michael on why he sees a soft landing in the US economy. That conversation next. Coupon hunters of the world unite. Stock set for a lower opening. It's like the field of dreams where tech came to be pricked this morning. You've got Tesla under pressure on a pay deal. You've got AMD down on the guidance. But let me get you up to speed with your morning calls. Here's a look at what some of the analysts are scribing from the street. First up, Morgan Stanley downgrades Sophie Technology to underweight, seeing headwinds in the near term to revenue growth. Next up, Barclays downgrades Verizon to equal weight, expecting limited upside given the stock's rich valuation. And finally, Argos downgrades UPS to a hold, highlighting the company's disappointing results, the tepid outlook despite the job cuts that we saw yesterday. Coming up with me, it is JP Morgan's Bob Michael, setting the stage for the Fed. Are you nervous? Technology market has had a puncturing of optimism this morning. The Nasdaq set to open down by 1%. S&P 500 also lower. Do you see this as an opportunity to step in? If you get a drawdown on Microsoft, on Alphabet, on the likes of Tesla, on different stories, is this your opportunity to step in and buy the proverbial dip? Camera's out, the bell is ringing, the moment is live. We're live for equities. It's a lower opening. And in terms of one stock to watch at the open, I mentioned it is Alphabet, the search engine revenue missing the analyst estimates. That overshadows the otherwise strong end of the year. Abigail Doolittle can disaggregate the two. Abby.
Well, as a result of that disappointment, Manus, we do have the stock down more than 5%, heading to its worst day since October of last year. And relative to the quarter that was, I would describe it as messy. There are bright spots, but in terms of adjusted earnings, it actually missed. Revenue did beat, so that was solid. But the big point of contention, as you mentioned, is the fact that the ad revenue missed, not in a a big way. $40 billion missed the estimate just slightly, but investors wanted more. It does suggest that the search demand on Google, because it was the Google ad revenue, that it's waning. It's not quite as strong. And one analyst is describing this from the standpoint that that is the cash cow as they try to move more into AI. A lot of analysts think that they're behind on AI. Their Gemini product, of course, launched recently. That it's just not great to have these kinds of ripples with their cash cow stream of business, that revenue line, that ad revenue from Google. As for the stock, 9% up into the year, into today, up more than 50% over the last year into today. Price perfection, they didn't get it. But there was that big bright spot that I think you were alluding to, Manus, and that, of course, was the cloud. Revenues there more than doubled, but against the backdrop of that disappointing search and ad revenue outcome, investors just don't care. The stock down 5.4%.
You're right. And then, of course, you look at Microsoft, you begin to understand. We'll stick with that theme. Abby, thank you very much. It's about the strength of the revenue. There's a strong revenue growth there, but it was the cloud growth that disappointed some investors. Ed Ludlow is with me. Ed, I mean, if you look at the AI component here, it is boosted sales by 6%. But there seems to be a disappointment, not so much with that number, but with the lack of huge forward guidance on AI.
Yeah, high bar quarter, elevated expectations. Dan Ives at Wedbush has this note that Satya Nadella delivered a masterpiece that should be in the Louvre. The market doesn't agree. We're basically flat on the stock. But you are right. What they needed to do is demonstrate how all the hype around AI and the investments they've made in AI translate to both the software that they sell to customer and enterprise and on the cloud side. And so a top and bottom line beat. Azure, the cloud unit growth, was 30% in the quarter, up 1 percentage point sequentially from the prior quarter and ahead of estimates. And you're absolutely right that Amy Hood, the CFO, told us in an interview, in terms of size and scope, that AI had around a 6 percentage point benefit to that growth rate on Azure. But very elevated expectations. And I guess one looks at the run-up in the stock toward the end of 2023 and the beginning of this year, taking Microsoft to that $3 trillion market cap and above Apple as the world's most valuable company, and then compare and contrast with Alphabet, for example. You know, when I interviewed Ruth Porat, the president and CFO of Google or Alphabet, they had similar growth in cloud and gave some evidence that AI was a contributing factor there, just not as much evidence as Microsoft gave. The muted reaction is we're up 0.3%, but I think Microsoft this morning probably still the winner of the 3 AI names that reported last night.
Listen, I think it's very much about front-running the scale of delivery of AI, and that's going to be at a different pace in different companies. This is not an NVIDIA story inside Microsoft. This is an AI adoption story. Let's talk more about the chip story. AMD giving a weak forecast, disappointing investors despite the new prospects for the, you got it, AI processors. Katie, translate for me. Good morning.
Well, Manus, 24 hours ago, we were talking about that hype around AMD's new MI300 chip. And as you're seeing in the shares this morning, that alone wasn't enough to offset the weak guidance that we got from the company. Specifically here, the chip maker said that first quarter revenue will be about $5.4 billion. That is well short of the $5.77 billion that analysts had been looking for. And really, this report echoed concerns from what we heard from Intel last week, that you take a look at customers and they're holding off on buying PCs, servers, and game consoles, and those are AMD's core markets. So that's weighing on the stock this morning, even though you did have analysts cheered about its push into AI accelerators, like you mentioned. Specifically, we're talking about that MI300 chip. That's designed to help companies develop their AI models, and it's supposed to help AMD compete against industry leader NVIDIA. And it does see sales of more than $3.5 billion for this chip this year. That is up from an earlier forecast of $2 billion, but it's still below the most bullish fantasies for what sales were going to be. And of course, AMD is still early in this expansion. You add it all together, shares off by about 4% right now.
Okay, Katie, thank you very much. It is all about the forward guidance. Let's stay with the earnings. Starbucks lowering the full-year sales outlook while maintaining confidence in its profit goals. Simone Foxman has the details. Simone, what have we got?
Yeah, Manus, we're seeing shares rally in early trading despite the fact that there was not much good news in this report. The company missing estimates for its latest quarter and lowering its full-year sales outlook. But overall, the street finding that these results were better than feared. Edward Jones writing that the street had estimates that were even below what the official consensus was. First quarter results, if you dive into the numbers here, comp sales expected to rise by 5%. The expectation had been that they would rise 6.4%. That is the most recent past quarter. Underperformance in every geographical sector, but especially China and international. This was the slowest growth in a year. Earnings per share narrowly missing. Ticket size also rising less than anticipated. And for the full year, Starbucks saying it's going to see just 4 to 6% comparable sales growth, down from as much as projections of 7%, but did. That is one of the bright spots, maintain its EPS growth guidance of 15 to 20%. Bulls, however, seeing glimmers of hope, in part because of the maintenance of that guidance. Wells Fargo also saying that full year 2024 targets are more achievable now that it's set that lower expectations. But maybe what we're seeing in the stock is simply a reaction to the fact that shares are down 13.8% this past year. So maybe seeing some room for profitability ahead, Manus.
Okay, Simone, thank you very much on Starbucks. One breaking news headline, one stock which is in focus. I just want to bring it to your attention. It's a New York Community Bank Corp. Stock down 41%. This is one of the regional lenders. It bought deposits. Take your mind back. It bought deposits from Signature Bank. $38 billion of assets from Signature, 25 bucks of cash, 13 billion of loans. A surprise loss for the fourth quarter, cutting the dividend. It's talking about loan loss provisions soaring, weakening credit quality, lowering the quarterly payout to shareholders. Canaries, coal mines, make of it what you will. But it's a gouging of New York Community Bank Corp. Joining me now is JP Morgan's Bob Michael, looking ahead at today's Fed's decision, and this is what he's got to say. The Fed has done a very good job of getting us to a soft landing. The moderation in inflation has given them reason to guide the market to rate cuts in the first half of 2024. And it's not just the FOMC decision. We've had the Treasury refunding size, boosting the size of its quarterly issuance on longer-term debt for the third straight time. Bob joins me now. Bob, good to see you. What is today's objective for Powell with this market? You're talking about front-loading rate cuts. Everybody else has come through here has said to me back half of the year. Why are you locking for the front half? Good morning.
Good morning, Manus. Manus, I'm going to tell you today is the best day ever for the Fed and Jay Powell to walk in and give a 30-second press conference. He should walk in, survey the room, and say, 6-month annualized rate of core personal consumption expenditures, 1.9%. 2% inflation target met. Look at unemployment. On Friday, we're going to have the 26th consecutive month of 4% or lower unemployment. Full employment, box ticked. And today, we got the employment cost index. It was up 0.9% on an annualized basis. That's 3.5%. That's the 2% inflation, 1.5% productivity gain. Box ticked there. Told you so. Take the mic, drop it, and walk off the floor. We're in a soft landing. They've done a brilliant job.
It's like you two playing in Las Vegas, isn't it? Drop the mic and walk off. Treasury yields dropped. A very short end of the curve, Bob. Look at this. 421. We are down 10 basis points. Now, part of this is to do with the quarterly refunding. Part of it's to do with the data. When you look at the quarterly refunding, what did you make of that?
I think it was pretty straightforward. I think the market is looking at the totality of everything and saying, if we're in a soft landing already and you still have rates at 5.25%, 5.5%, and full balance sheet runoff, then the risk is to the downside again. So the Fed can start cutting rates sooner than the market is anticipating. And then the Treasury didn't surprise with an enormous amount of quarterly refunding. It came in a little bit lighter. Mm-hmm. We were told that a couple days ago, and they came in true to form. The market's ready to absorb it.
Bob, if you're ready to have Powell drop the mic and have his Stardust moment, do you think they would cut by 25 basis points in March?
I don't think so, only because 2021, I think, is still very present to them, and they were a little bit slow to hike. They can't take the chance on being wrong on inflation again. So I think all things being equal, June still looks like the right date for them to have those discussions about cutting rates. But I think they have to start. They have to start telegraphing to the market that they're ready to cut rates. Because when you look back at 1995, which is the one soft landing everyone talks about, they cut rates 3 times during 1995. So they started to take pressure off the system. They can't leave rates where they are. They can't keep running down the balance sheet at the current pace. They need to start dialing those back. I don't know if it's May or June, but somewhere in there strikes me as the right time to begin.
I'll come back to the QT in just a second. I'm looking at a slightly longer chart of bonds. 417 was the mini recent peak that we have. We're down at 395. So is that backup? I call it a mini U-turn in yields rather than a backup in yields since we last spoke. So we've given some of that back. Is this the beginning of the next significant bull run in preparedness for what you've just laid out in front of me?
Manus, I have conversations every day with clients on when do I get into the bond market, where do I get into the bond market, how do I get into the bond market? And everyone wants to get in back where rates were in October and November, and they're a little bit frozen here. The one interesting bit of data is to look at the aggregate bond index. Today, it yields 4.7%. December 31, 2022, so 13 months ago, it yielded 4.7%. And at the end of 2022, we were looking into 2023, the Fed hiked rates 4 more times. As we look through 2024, we should see at least 4 rate cuts. You get a total do-over. You should be getting into the market at these levels because once the Fed starts bringing down rates are going to fall a long way from here.
Yeah, a lot of that, Bob, is, of course, fear, frozen, looking at it going, you know, I want to time it, I want to be perfect. But nobody ever gets the timing of this thing perfect. And if you're swinging around, if you're in or out late for 50 basis points, it's not the end of the world. Tell me this now. U.S. corporate bond sales, $188 billion in January. The spreads are tighter than a proverbial. Were you more of a buyer? I'm interested. Are you more of a buyer of credit relative to treasuries in this January? I mean, it was like the January sales. It was like Christmas ran on forever, wasn't it?
So we are, but let me go back to your comment that people are a bit frozen and want to buy backup. They're also incredibly comfortable in money market funds and collecting 5.5%. And it's hard to shake them out of there. So once they see the Fed beginning to bring money market rates down and cutting interest rates, that's going to have them piling into the bond market. And that's what worries me about where yields are. And I know everyone's worried about the amount of Treasury supply and corporate supply. Simply the fact that Treasury yields are completely below the Fed funds rate and corporate bond spreads are where they are tells you that supply is not an issue for the market. It's completely absorbed it. If anything, we could use a little bit more because we've got $6 trillion in money market funds, and a fair percentage of that is looking to come into the bond market.
Bob, make sure the JP Morgan Asset Management truck is at the front there to load up with those treasuries when they come. Good to see you. Setting the stage for the Fed's decision this evening. Coming up later is the Morning Consult poll. What does it reveal? It's bad news for President Biden.
There still is time for the public to feel the economy is getting better. There's still an outside shot for an immigration deal, but there's a lot of potholes.
The latest developments out of Washington, D.C. and what it all means for markets. That conversation on Bloomberg. Let's get you a fresh piece of economic data. It's crossing the Bloomberg terminal. Mike McKee is with me. What have we got from Shai?
A little bit of a sour bit of data. The Chicago MNI Purchasing Managers Index falls to 46 from a revised 47.2. It was thought to rise, so this is a disappointment in that sense. It follows the Empire Index from New York and the Philadelphia Fed's Index in going down significantly. So we'll see tomorrow when we get the Purchasing Managers version that the national number, ISM manufacturing, expected to fall just a little bit, but maybe manufacturing is in more trouble than we know, Manis.
Okay, Mike. Again, another piece of the jigsaw, perhaps about the economy, the real economy that's going on. Mike McKee in Washington there. So from the economy to the Hill. A Bloomberg News Morning Consult poll reveals this. President Biden trails Donald Trump across 7 critical swing states, but more than half the voters wouldn't support the GOP frontrunner if he was convicted of a crime. Anne-Marie Jourdain is with me side by side. So, Anne-Marie, the top takeaway here is obviously Biden is trailing Trump, but there's a real risk for Trump in this analysis, isn't there?
Yeah, there's vulnerability for Trump, and that comes down to the indictments against him. And you have more than half of the swing state voters saying that they are not going to vote for him if he was convicted guilty. But let's look at some of the issues that the current president is facing when you look into this poll. He's trailing Trump in these key critical battleground states where elections are won and lost. And the main issue right now is the economy still continues to be a chief concern, but we are seeing more respondents in this latest iteration of this poll that say immigration is becoming top line for them, and that's one of the key issues. So you see the margin now starting to close a little bit more between the economy and immigration. If you ask voters who are 65 and older what they care about, it's neck and neck for the economy and immigration. So people might start feeling a little bit better about the economy, but they're worried about the border. And why this is so important is because right now, Manis, in Congress, they are discussing a potential border deal. And President Donald Trump has told Republican colleagues of his in Congress, these lawmakers do not accept a deal unless it's perfect. And obviously, it's not going to be perfect for the Republicans because they're dealing with a democratically controlled Senate and a Democratic president.
So, I mean, the issue is this. Immigration has gone right up the agenda. And, of course, we did the poll January 16th through 22nd. Now, this was before the famous words from the president where he says he wants to shut down the border right now. So that's trying to re-grasp the narrative. This tells me that the GOP is winning the news battlefront relative to the Democrats.
When it comes to immigration,
yes.
When it comes to also crime, when it comes to how Americans feel about who would be better in terms of two wars right now.
So they trust Trump more than that?
In Gaza and Ukraine, they still trust Trump more on some of these critical issues. But also when it comes to winning the hearts and minds of Americans when it comes to immigration.
Yes.
If you also look at some of the data in the media landscape, conservative media talks about immigration a lot more than what you'd see in some of either progressive left or mainstream media. So also that's capturing some of these issues. But it's interesting because immigration is still an issue in places like Wisconsin. That's nowhere near the southern border.
Yeah, but this is almost, I mean, it's a bit of an extrapolation here, but I spent many years stuck in the Brexit mire. This is very reminiscent of the politics of Brexit, which is about putting up borders, closing down immigration, save our jobs, save our nation, America first, Britain first, whatever else. It's a quasi-escalation in a Brexit context.
Well, also what's happening in the southern border right now is it's record numbers of flows of migrants coming in. Some days it's 10,000 or more. So it's become also a huge humanitarian crisis. When you also ask voters about who is to blame for this, that blame falls to President Biden mostly and Democrats in Congress, but also these voters understand there are geopolitical tensions at play here. They talk about famine, corruption in a lot of these countries, that they understand why migrants and why people want to flee to the United States.
And again, that plays much more then to the foreign policy of the United States of America if you want to remedy some of the immigration issues. Anne-Marie Jourdain.
Root causes.
Root causes. Up early and staying late. That's what we like. It's called Bloomberg Productivity. Let's get a little bit more sector action. Abigail Doolittle is on the desk with me.
Manus, with this 0.6% decline for the S&P 500, not surprisingly, more sectors are down, not by a lot, just by one. But communication services being weighed on by Alphabet, down 3%. We also have tech down more than 1%, being weighed on by AMD and others. Energy down 0.7%. To the upside, we have some of the defensive sectors like healthcare and utilities. So this is really risk off. Relative to the month of January, though, it's interesting because communication services, the top sector, up nearly 6%. Tech right behind it, up nearly 5%. To the downside, today's top sectors, real estate and utilities.
Okay, Abby, thank you so much. Abigail Doolittle coming up on the show. Market moving events of the day. There's nothing else you really need to know. It's Fed Day. It's a brutal day for tech, there's no doubt about it, down 1.1%, and Google is taking the heat as the ad spending number is just not on the ticket. Keep an eye on those tech stocks. We're all eyes down today for, of course, the Fed. 2 p.m. Eastern Time, followed by Chair Powell's news conference. Bob Michael, line of the day. Walk in, do it in 30 seconds, and then drop the mic. Qualcomm, those earnings hit the tape after the bell. More on the chips business. Tomorrow we turn our attention to Bailey at the Bank of England, and Amazon, Apple and Meta earnings hit the slate. Finally, Friday, you got it. Jobs report for the USA. That is Countdown to the Open. This is Bloomberg.